Good morning, guys. Julian Williams here. Happy Monday. Hope you're having a blessed Monday this morning. I get the privilege of hosting global trading experts Boris and Kathy from BK Traders. How you doing this morning, guys?
We're great.
Doing good.
Hanging in there.
Excellent. Boris, we missed you last time. Everything good. Now we're back in. We're used to our usual, our tandem here going.
Yes, we're ready to roll. I had to get my papers in order for all the trips, which, by the way, I think that's sort of like, we're coming into the Easter Passover season for a lot of the markets. Hang on just one second. What is going on over here? Sorry, I just got to close out this,
no, you're okay.
This trade. It's driving me nuts. Come on, get in there.
Which one were you in currently, Boris? You're in SPX?
I'm short NASDAQ, and it's like, so annoying. Okay.
Yeah, today's definitely been,
you know what today is? Today is a day where it comes to within half a tick of your profit and then goes the other way. That's what today is like. This is exactly what's been going on. That's why I just wanted to close it out before it goes. That's exactly what it's like. It's kind of my whole point about Easter Passover is this is, and Kay will probably agree with me, aside from Christmas, we're coming into the slowest part of the season. This seems like where everybody just kind of diffuses and goes away, on these 1 week, 2 week vacations. And the markets just get soggy and completely non-directional and really frustrating. Every breakout is a fake out kind of a thing. And I remember every year I keep saying to myself, Easter season, I'm just not going to trade, because it's and sometimes I remember like when I was trading FX, it was worse trading Easter season than it was trading Christmas week sometimes, just in terms of just unbelievable.
Boris, what would you say is the window? Like, what's the window of tough trading during the Easter holiday that everyone should be watching?
It's like the first 2 weeks of April, like after U.S. pays taxes, April 15th, that's when things come back to life, I think. But like those 2 weeks are just tough. And that particular week, that 7 to 15 week, which I believe is Easter week, because that's like the end of Passover too, because it's always like, interest, just seems to really, really, have, because the other thing is Easter holidays on like in UK, which is the heart of FX dealing, like they have Monday off, Friday off, like, they basically kind of just kill the whole week. So there's very little liquidity to make it all happen. Right, Kay?
It's very interesting that you say that because seasonality is very important. And, to be honest, I didn't really think about it all that much. And as you're speaking, I'm going back to my performance in the first 2 weeks of April for the past 3 years. And it's true. I mean, last year, for example, last week, I made 240 pips. The week for that, 180 pips. But last April, as Boris was talking about, the first 2 weeks of April in 2022, I made 9 pips one day and I lost 2 pips the other. And then the year before that, let me just track back down here. In April, I lost 200 pips. And then the year before that, I made, 30 pips and then like 50 pips, which is nothing compared to what it normally is. And I think that's really indicative of the kind of tight ranges that, you see in the markets. For example, today, I've been tortured by a short dollar Swiss trade. I had my zip sell signal, I went short and, I had, good size in the position. But, it is exactly 91.66 is exactly where it was at 6:30 this morning. And so, that tells us that, this is just a reflection of what's going on. And I think, Boris is right. The seasonality is in play right now. And maybe it's better to just, minimize those position sizes or stay on the sidelines or only be super selective these 2 weeks. Because first off, it is clear this week that we don't have a huge amount of data. So that's going to be, that's going to be ripe for consolidation. Secondly, we're coming off huge, big news weeks. And so consolidation is itching anyway. And then we have the seasonality factor. I'm going to do a video on this.
There you go.
I gave her an idea. Good. Yeah, the other thing I think to add to kind of salt to the wound of all of this is the idea of diffusion. So basically, for the last 10 years, when the Fed was zero interest rate policy, it was a really easy trade. It was just like risk on, risk off. Like literally every stock market in the world would rally, every stock would rally. You didn't have to, you really didn't have to be a genius at selection. It was because money was free. When interest rates were free, there was no need to allocate capital, right? All instruments either rallied or they declined when there was some fear that the money was going to stop being free. But now that you have a very different interest rate regime across everywhere in the world, right? So like it's not everywhere in the world used to be zero, so it doesn't matter where you went. It was just basically however much money you could get. Now, it costs you, so you have to go to different places depending on how much money it costs you, and what that creates, and this is a concept that I've been listening to a lot of analysts talk about in the stock market. It becomes, instead of being a stock market, it becomes a market of stocks. So each individual company becomes that much more interesting and valuable because how they employ their capital against, a 6-7% rate against a 0% rate, is completely different. You got to be a lot more efficient. You got to be a lot more productive. Well, that creates obviously very different performances within stocks. And I also think same kind of thing applies to currencies because currencies now carry very different yields of return, each one of them. So, something we don't really trade, but I was listening to this guy from Falcon Management, Jim Leitner, who's a very, very smart macro manager. He's talking about Mexico, that Mexico as a currency seems like a really interesting bet because, or Brazil was another one. Brazil, for example, has like 11% rates and only 5% inflation. That's one of the highest interest rates in the world. So that means that their rates are probably going to come down. So that's going to create, a really interesting carry trade possibilities, for the trade until it comes down. So like there's just all sorts of nuanced, different stories now instead of just a single story in stocks and FX because interest rate differentials across the world now create very different scenarios.
Right. Well, guys, I think the biggest headline today is First Citizens. Let's dive into that a little bit. Give people confidence. Now that we've got a new buyer, scooping up SVB, or what do we think?
Well, I think one of the main theme today is risk recovery. And I think the primary reason why we're getting risk recovery is because some of the uncertainty around the banking sector is easing. Last Friday, we talked about Deutsche Bank, how, the market was attacking Deutsche Bank shares. We talked about how, Germany was not going to let Deutsche Bank fail. And today, Deutsche Bank shares are rebounding. First Republic, snapping up SVB. And I think, all of that is playing into, the market feeling a little bit better and basically feeling like, maybe the worst is behind us. We'll have to see. I mean, First Republic, is a prestigious bank. I don't know if you know, but Mark Zuckerberg got a mortgage from, I don't even know why he needs a mortgage, but from First Republic. And so, it's got, it's pretty well known, even though it's not the JP Morgan or Citibank of the world. And so I think that, that this is a move in the right direction. This is a move in the right direction for First Republic. It's a move in the right direction for the banking sector. I still believe that a lot of little ones will fail. But for the time being, I think that, I can never predict whether there's another blow up that's going to happen with the bank. But today, we know at the start of this week, the market's feeling better about everything.
Good.
The banking story is interesting because, like kids, the longer it goes without further blow-ups, the better it is. And we go like a whole week without a headline. I think it's reasonable to think that equities kind of bounce because it's a relief rally. But where the landmines lie may not necessarily be the U.S. The fear here is, you have Deutsche Bank, Société Générale in France, and I forgot which one in Italy that may be vulnerable. Now, I'm pretty confident the ECB is going to do everything in its power to shore up European banks. The absolute last thing they need right now with strikes in Paris and a land war in Ukraine is to have any kind of banking crisis in Europe. But I do think that is a risk that traders should keep in the back of their minds, because that is something that could blow everything up unnecessarily. So yeah, I mean, right now, the longer we go without a negative headline, the better it is, I think, for risk assets.
But I think also the headlines from Europe tell us that the regulators in the euro area are going to be very vigilant about this, and they're not going to go the way as the Swiss. And the crisis of confidence is a much bigger problem, I think, for euro area regulators than right now for Swiss regulators.
Immobiliare. The Italian concern was the Immobiliare, which has always been like on the verge of collapsing or not collapsing. So yeah, and I think that's sort of that is the background story. In the meantime, we're just trading back and forth, trying to scalp a pip or two here, because that's really the kind of market it is.
I think what I should be using is here's my magic. Let me see if I get it on screen. My magic 8-ball. So I should be taking my magic 8-ball, whether it tells me to buy or sell.
So, okay, should we both do it at the same time?
Yes, this is what we should be using.
I gotta get one of these.
That's what we're resorting to. ACAP magic eyeball. What does it say to me? I can't even see it, because I think mine is like damaged from being sent over from Australia. I can barely see it here. What does it say? Oh, it says risk is on. Mine says risk is on. What does yours say?
Mine says cut your losses.
See, even the 8-balls can't synchronize. That's the kind of choppy market it is.
Exactly. Now, all in the background, I'm reading articles about the student loan moratorium. What is this about? Now that people are going to start having to pay their loans again, come August. That's 40% of banking asset. Is that going to take a big, people are afraid that this might be the other, big bad wolf that kind of just continues the turmoil we've had with all the banking stuff, or what's your opinion on that?
I'll let you share your thoughts for us.
I'm sorry, you said that the 40% of banks' assets are in student loans?
Yeah, exactly. Besides the 25 top assets, in banking. Says that, as far as commercial real estate, stuff like that people are going to be pressured, now having to do, I think the average is 393, it said, as far as people's student loans are going to have to pay. So does that slow down, the markets, because people are now having to worry about,
it could, again, I think it's like, it's the spread between what's the monthly nut on the student loan, because it's really about the monthly nut, right? What is your monthly spread versus your wage gains, which have been 2.5%, 3%. So I don't think it's kind of a thing that's going to be a instant shock to the system, but it definitely can dampen demand a little bit. A lot of this stuff is legislative, right? I mean, like we don't know where the Supreme Court is going to land on the whole debt forgiveness thing. We don't quite know how that's going to play out. So yeah, I mean, you're absolutely right. But I do think these are, in the grander scheme of things, minor issues. It's $100 a month. What's much more important is that you have a $50,000 job, right? So I think we sort of need to keep the eye on the big ball, that as long as the labor stays buoyant, and that's a big thing. So that's another thing that kind of came up today. Was another interesting conversation that came up. We talked about this in live trading today, actually. So a very, very important spread that Kathy watches all the time, everybody on Wall Street watches, is the 2s against 10s, right? That's the sort of the dominant spread. It's a 2-year against a 10-year. And obviously in a perfect world, the 10-year is supposed to be bigger than the 2-year, right? It's called a steepen spread. And that just basically suggests that there's growth, there's better in the economy. We've had what's called an inverted spread, where the 10-year is way below the 2-year. And that's partly because of inflation, short-term rates, Fed controls short-term rates, and they've had that. However, what's happened over the last 3-4 months is that inverted spread has really, it was like something like 80, 90 basis points, and now it's only 50 basis points. It's really compressed. So there's two thoughts of school on that. One is, oh, that's great. That means that market is feeling confident that, growth is coming back, long-term rates are coming in, but it's actually short-term rates that are really coming down right now. The other school of thought is like, no. This is actually what happens in front of every single recession. What happens every single recession is first the market like kind of really gets inverted. Then it gets steeper, and it's when it gets steeper that's when you hit the recessionary spiral. So who knows? Every I think historical event is kind of different, but it's just something to keep an eye on. I mean, I think that the 2-10 spread, the bond market is kind of interesting to keep an eye on. It's one of the major major factors that everybody on Wall Street watches, so we should keep an eye on it.
I think what you're, Julian, I think what you're talking about, the greatest concern I have is the overall impact on consumer spending. Right. And, we talked about how the credit crunch, the banking crisis, the rise in yields, the drop in equities, as well as just the volatility in the markets is going to lead many people to start being much more sensitive to their spending and being less free-willing. And if you have a sector, a part of the economy that now has to pay, higher monthly nut, I think, all of that plays into all of those warnings by consumer staple companies about what could happen in the second half of the year. And so a lot of them are worried about their own bottom line. And I think, if you look at the broader economy, what's happening in the markets, what's happening to everyday finances, all of that is going to, raise the risk of a hard landing.
Right. Yeah. I mean, like I said, I bring it up because, as you know, you had said it yourself, it's, not a super busy week coming up. Do we find stability in it? Do we, start to see trending markets, or people hesitant? Like you said, pre-market stuff because of First Citizen coming in, scooping up SVB. Obviously, the market did some nice pre-market moves here, but it's definitely chopping around right now. I think it's safe to say people need to take their profits, and kind of be very specific, like you said, with their trades.
I mean, there's basically 4 things to watch this week. The first thing being the banking sector headlines and whether or not they're new headlines, positive or negative. The second thing is we have a lot of central banks speak. From the US, a lot of Federal Reserve officials speaking, a lot of European officials speaking. And, the market, the Fed funds futures are pricing in 75 basis points of rate cuts this year, which is extraordinarily aggressive. And so they're going to they're going to listen to the headlines and look at the Fed speak headlines for either confirmation or to cast doubt on, what is already priced in. I think that from a lot of Federal Reserve officials we've heard that, they don't feel like they're done with raising interest rates. And I think you're going to see those rate cut expectations start to normalize. And what that means is you could see a bit more of a recovery in the US dollar, maybe a little bit of a pullback in US stocks, as markets realize the Fed may not be as ready to cut interest rates as what they're thinking. And number 3 is going to be inflation. We have at the end of the week, the number 1 most important inflation indicator the Fed watches, which is the PCE deflator. And so that's also going to either confirm or cast doubt on what the market is pricing in for Fed cuts. We also have Eurozone inflation numbers. And so that's, going to be front and center because ECB has been pounding on the table saying we are not done and we need to raise interest rates. So Euro's rallying because of that. But if those numbers come in softer, they could pull back. And then the 4th thing to watch for is China. We have Chinese PMIs midweek, and, they're expected to show the Chinese economy kind of roaring back after their COVID lockdowns. And that could be a big story as well.
That's an interesting story. I mean, actually, that's going to be a bigger story that I think people, there is this, just like, we've been waiting for a recession for the last 18 months, like I've never heard any more people call for a recession without it actually happening. The other big call has been on the idea that India is going to overtake China, both as the most populous nation in the world, and it's going to start having serious growth. And the interesting part about China, in my opinion, is like everybody still expects China to do that 5-10% growth, or let's say even just 5% growth type of numbers. And the question is, maybe that's not ever going to happen. Like, in other words, everybody was looking for strong PMIs, strong GDPs out of China. Maybe it's just not there. That's going to be, I think, a really big story that may be completely underappreciated at this point. In other words, if China can't really ever recover post-COVID to the kind of dynamic economy that it was, and there's lots of reasons to think that it may not. You have the demographic issue, you have obviously the COVID issue, But most importantly, and I think this is something people don't appreciate at all, is you have the political issue, which is that they essentially now went from essentially a quasi-free society with, as free in the economic sphere. Let's say they were, they could do whatever they want in the economic sphere, to now just a completely totalitarian society. That's horrible for innovation, horrible for capital formation, horrible for growth. And I think, you're just going to see much worse results out of them, and perhaps much better results out of India, because they're the exact opposite. They may be completely chaotic and completely disorganized, but there is much greater degree element of freedom there. Actually, saw a really interesting statistic. Do you know that India exported more dollar volume of software than Saudi Arabia exported dollar volume of oil? Something like 331 billion in software versus 313 billion of oil by Saudi Arabia. That's a really powerful statement on how the future economy of the world is all intellectual property rather than physical goods. So I mean, those are interesting things that I think people should keep an eye on.
I think the world is starting to quit China, and especially the manufacturing sector, and that's becoming a big trend. And China's trying to reverse that sentiment. The big news today is Jack Ma has shown his pretty face again after hiding out in Japan for a year.
Where's he now?
He is back in China. He, we went back to China. He's lecturing with a university about AI. And the reason why this is a big deal is because he fled China, and they were afraid that he was going to get captured and then stuffed in a cage somewhere, and disappeared. Actually, that's the word I'm looking for. They were going to disappear him, and he was afraid of that too. But the fact that he's back, it's in the headlines. He's, and China's not stopping it. They're embracing it. Maybe a sign that they're trying to send a different type of message to the world and to the market that they're doing things differently. I mean, look at how they exited COVID, and now they're trying to be a little bit less secretive, maybe with the business sector. So we could see more of that, and I wouldn't put it behind them.
Yeah, it's interesting. I think Z may have realized that he overplayed his hand. I don't for a second think that he's going to let go and suddenly everything is going to become highly open. But he may have realized that he needs to create a more open society in order for the economy to grow. So it's interesting. Yeah, it's a very interesting point about Jack Ma. The fact that he's back on Chinese soil is a big message to Chinese entrepreneurs that maybe they can go on and do their thing.
It's like almost front page headlines on most of the websites that you go to. So that it's something that the business, the market is watching very closly.
Yeah.
Well, guys, playing off of the macro news, I mean, this week in specific, because we don't have a whole lot of headlines, besides obviously these couple things, is price levels more important. You know what I'm saying? This week, I think we talked a little bit about that last week, heading into this week, that more important, looking at, S&P, looking at gold, things like that. Let's talk on that a little bit for the traders that are watching us.
Yeah, that's a funny thing, because that's exactly what we're talking about in our members webinar this morning. And Boris was pointing this out about how this is going to be a week about price levels and more about technicals than fundamentals. We've had weeks and weeks of big stories dominating the news, but now it's about being traders and focusing on those key points.
Yeah. Feel free to pull you guys charts if you guys want to kind of jump into something and kind of point out some levels that we may be looking at for this this week.
Sure. Are we in the chart sharing mode now?
You're in the chat. If you want to be, you don't have to be.
Okay. Hang on. Let me just get into my present. No, what is this? I want to share screen. Sorry. It's like, oh my God.
No worries.
It's
now,
like,
Captain, you talked about this a little bit last week. You feel like as people get, or not as quite as confident, or if they're not buying, the whole, the buyout, and maybe right now we're taking a bit of a rally. People start to, like you said, kind of depend on the dollar and start to trade. Is this a good opportunity for traders to start to jump in, Euro USD, things like that? Or what do you think? It's still very tight. Like you had said, are we just kind of consolidating? Are we bouncing around these areas?
I think the next 2 weeks is definitely more of a period of consolidation on a seasonal basis. for all the reasons that we talked about in the beginning. Also, from a data perspective, we don't have much this week. I mean, next week, things will get more exciting because we have non-farm payrolls again. And so that's going to tell us whether or not the labor market remains as tight as the Fed really says. So, I think it's more this week is probably be more consolidated, but the action will heat up again. The end of next week into the following week. And then we start to think about what's happening in May. I know it seems really far away right now, but a lot of people are still, uncertain as to what all of these central bankers will do in May. And that uncertainty will lead to more volatility as investors try to listen keenly to what these policymakers say and do, what the data indicates, and they position ahead of those big events.
So speaking of policymakers, this is the S&P chart. This is the MAS, right? And this is what's interesting. So when you're looking at this is the FOMC spike, right? This is the FOMC spike right over here, right? And to me, so it's basically a 38 to 4,000, 4,100 market, right? 3,900, 3,850 kind of a market, right? And to me, what's going to be interesting this week is to see if we can challenge the FOMC highs. If we take out the FOMC highs, that's a bullish sign. That means the market is going to be much more, risk on positioned. There's going to be less, concern about banks, even less concern about credit. It's basically going to be growth focused. Sort of the idea like, okay, we went through all of this, we stabilized the system, we can go back to making money and growing the economy at 2.5% real, and that's going to be good enough to take us through 4,000 and higher. So this is the key level. Let me just mark it over here. That we just got to be looking at. On the future, it's about 470, but that's it's basically that anything above that 450, 470 level, cash on futures, is really what we want to be looking at. It's just the idea of taking out the FOMC high. That to me is the most immediate challenge here. Now, when you look at gold, obviously the big level is the 2. You can see I have my 2 marked right on the spot, and we just keep bouncing back, bouncing off. What's interesting from a technical perspective, of course, is we all know that it's like a battering ram, right? The more times you butt your head against the wall, once it busts through, it's just it starts to run through. It's like a stampede. So we need to see where gold is, because I think if gold takes out 2,000 this time, that could be a real run, and that could be a run where we could have fresh all-time highs, and they'll start, once we get fresh all-time highs, it's going to start putting everybody in the headlines and all that kind of stuff. So need to watch this, or this could be just yet another, broken heart day where we just, we tested 2,000 and kind of wallow and start drifting back down. As far as the downside, when we drift back down, I think we need to.
Of course, what do you think takes us to 2,000 and surge above that? What is it? Any particular news we should be looking out for? That can tell us?
Banking crisis probably is the most natural, right? This sort of like hard money, right, versus soft money kind of a thing. So I mean, this you're looking at this on a 4-hour. This is a clear double top right now, right? It's nothing, but that's By the way, every formation is a counter formation to it. Just sort of like every pattern is a counter pattern. That's what people like who maybe new traders don't understand. There is no such thing as a double bottom. It's only a double bottom in retrospect. If this, for example, consolidates, breaks out, it's actually, a double top. It's only a double top if this thing breaks down. If it doesn't break down, it's actually a double bottom consolidated, goes to the upside. So every pattern within it has the seeds of both bullishness and bearishness, depending on how it develops. So do not get hung up on one way or the other. You have to be flexible enough to see it both ways. But as far as looking at the levels here, obviously, I think $1,900 is the first level, but then that 1850, 1830. I mean, if gold breaks that down, that's just going to break a lot of hearts. Hard to tell right now, but the most immediate focus is this, and as I said, we take out 2,000, hold it. And what I'd love to see, remember, I said to you, I want to see it hold it on a daily basis. We haven't held it on a daily basis. Need to hold it. If we can hold above 2,000, that's a toe hold that could be much more meaningful. That we could see 2,500 very, very quickly. So, there are a lot of people who like to trade gold for the surge, prop evals. This could be your moment.
This could be your moment.
This could be your moment. So get ready. And then BIT is also kind of been threatening that 30,000.
Yeah.
So kind of coming in. It's hard. I'm at a loss for words as to crypto. It's funny because same guy, Jim Leitner, who is a very, very smart macro guy, and he actually has some money in crypto. He did say, I would have thought by now it would have more of a use case. And it's basically to me is an asset that has no use case whatsoever. But it is what it is. We trade the chart. It's not the market how we want it to be. It's how it is. And it's definitely much more bullish than bearish at this point. So we have to respect it. But it is kind of dying out in front of that 30,000. So again,
do you see it hitting a bit of that support there down at the bottom? You think it's going to go down to that next level there?
It's a $20,000, $30,000 trade, right? That's basically what it is right now. I mean, it certainly looks more bullish than bearish. You got higher lows. They bought the dips. They consolidated. Bitcoin. Obviously, I think if gold goes 25, Bitcoin is going to follow. This is in probably what we're seeing on the charts is the imminent development of global banking crisis collapse kind of a story that that could break out on as Kathy likes to say, there's more than one cockroach. If we start seeing more panic headlines, this is basically panic. This is the panic trade. The panic trade is gold and Bitcoin, and we need to keep an eye on it because it may well be the story as we go into the summer.
Okay. I don't know. This chart looks pretty bearish to me. So
which one? The Bitcoin?
Yeah.
How's that look bearish to you? Oh, because of the topping formation?
Yeah, the topping formation, the consolidation, the new the lower low, lower high, lower low. I mean, Bitcoin.
You're looking. Oh my God, this is by the way. Okay, so when people give opinions on charts, this is very, very funny because Kay and I are doing the exact same thing that almost everybody else does, which is I'm looking. Ironically enough, like an investor. So let me hang on a second. Let me see just if I can let me get where are my little things here. Where's my little tools to? Oh, here it is. I want to annotate this a little bit for everybody. So what I'm looking for is I'm looking at these big levels. Oops. Ooh, look at this circle. These big levels over here, right? So let me see if I can do this. Is control? Is it control? Why is this not working? God.
But what are you trying to say with that?
This is me trying to use tools is like always, it's like teach grandpa how to drive. Okay. So my point is that when you're looking at the longer term chart, you see very, higher lows. That's sort of bullish. There's definitely, consolidation. So what Kay is looking at is perhaps a near term move down to 5, which is, vertically reasonable. I'm thinking that long term, it's still maintaining its, structure. And it could still make a run towards the 35. But yeah, near term, it's definitely this very, very toppy over here. Let me go to one more circle here, and you can see it.
I mean, 2,000 points is, a big move. I think it could easily slip from 27,000 down to 25,000.
Oh, yeah.
So you could either sell now and buy, or buy in a dip. And that's what I see, as the opportunities. I mean, it's a lot, 2,000 points is a lot of pain for people who are holding this. So yes, in the long term, looking all the way back down to, 16,000, we're in an uptrend for us. But I think, 2,000 points for
2,000 points is a day's work in Bitcoin. No, I mean it all. Again, she's right. Depends on your leverage, depends on your position and stuff like that. I'm just sort of looking at, and again, we're talking about longer term levels, right? Because S&P today is bearish, but long term could be bullish too. It all depends whether you're trading S&P. It all depends whether you're trading the 1 minute chart or the 1 month chart. So that's
there you go. I think, and you can probably, correct me if I'm wrong, Boris. I think Bitcoin is very similar, only in the sense of very exaggerated wicks and things like that, like a US 30. It's like one day it's way up here or earlier in the day, and then all of a sudden, So you kind of have to, like you said, be familiar with this market to get into it because it can be
absolutely
dangerous.
The volatility signature of Bitcoin is, incredibly. It used to be like trading 200% volatility, literally, which is just huge. Now it's really calmed down, but it's still I would probably say 3 or 4 times more volatility than US 30, which is which is the most volatile instrument.
Right.
Yeah. But what that means, by the way, the other thing is I was going to say, I hate these fancy words. I hate the word volatility because it means nothing to anybody. When somebody says, it's 20, 25% volatility, 100%, what does that really mean? In plain English, if you're a trader, what you really want to say is its range is 2,000 points a day. Its range is 1,000 points a day versus a euro whose range is 50 points a day. That makes it, I think, much more tangible to somebody who's trading to understand how they should be putting stops, targets, sizing, and everything else. I mean, you can't trade something that has a 2,000 point range the same way you're trading something that has a 50 point range. But that's what it translates to in real numbers, Like that's how you should be thinking about all that. Just like with options, I hate people say, "Oh, I'm selling volatility, I'm buying volatility," or the spread has a large implied volatility. Why don't you just simply say, if you sell the straddle on this particular option, your break even is 10% up and 19% down, of the underlying price. Like that makes it so much more tangible. You're like, oh, Tesla's got to go up to 185 and down to 135 before I lose money, or something like that. It's just so much more tangible than using fancy words, which everybody on Wall Street loves to do, but mean nothing to a regular trader. I was actually going to write a column about it this week. I spent the whole weekend coding, but that was going to be my column about ranting and raving about making things unnecessarily complex.
Fancy words, yeah.
fancy words and little results. So that's it. Oh, the one thing we haven't talked about is it's kind of been dead, probably because we haven't talked about it, is oil. So oil is oil, as we see in your oil, 33rd and 3rd. So oil, where am I at? This is what what chart is this? 4-hour chart? Okay. Oil kind of, there's a reason we haven't talked about it. First of all, look at the compression of volatility. Again, I'm just, or the compression of range. It's only been a $5 trade for the last couple of weeks, right? And it's sort of, let's go to the daily chart for just 1 second. Let's see what it's doing. So it kind of dropped from 80 to 65, held. But what you're seeing here in oil is this pattern of just lower and lower and lower lows. But the question is, and I'm actually curious what Kate thinks about this: are we sold out? I gotta believe. I gotta believe that it's more of a buy than it is a sell on a longer term basis. Because do you really think we're going to go to $40? Well, we could go to $40 oil, but if that's the case, that's going to be our least of our problems. That means the global economy is in major recession. But we are seeing, really significant drops. So this is 86. This is 76, so $10 drop. This is 70, so $5 drop. And this is back down to 65. So, the pace of drops hasn't really increased a lot, but we certainly haven't really stabilized. You can take a punt here and say, okay, I think these are seasonal lows. We're going to the driving season. I think oil is going to percolate up. Maybe it's a trade. It's certainly a reasonable risk trade. Very, very clear.
I think if you're an investor, if you're an investor, I think oil, these are great levels to be long oil. And even as a trader, oil is, it's showing signs of a bottom. For me, it's in my zip buy zone. So it's already moved into, an attractive, pretty much when it crossed above 69.50, that was when it moved into a zone of buying, and where it shows that the sentiment has completely shifted. So, all of that I think is good for oil. But if you look at the chart that Boris has, if Boris can zoom in a little bit, you will also see though that 74, 75, more 74, I think, than 75 is a pretty significant support level because it's a former breakdown.
Yeah.
So, you got opportunity from here to there, a couple bucks of opportunity that I think is pretty high accuracy from here, 71 to 74 and a half maybe. But
that's a great trade, that's $3.
So that's a good opportunity. But once we get around there, we're going to have to reassess what's the broader story that's driving the trade. But even as an investor, I think these are good levels just to start getting into it. That's it.
Lever up the whole account into oil. We'll see you on Friday after you've passed your eval. Please. I need a disclaimer. This was a joke. I wasn't being serious.
Well, actually, we do have one of those questions. I'm not sure if you saw that there, Boris, on our page. Yeah. What is the trade, or what's the pair that we trade to finish our contest and pass our audition?
What's the payout trade this week?
Exactly.
That's a tough trade. I do not have I do not have any payout trades.
I actually am pretty bullish US 30 this week. I think that I don't think we're going to get much. I think we're going to mark some in recovery mode, consolidation with, an upward bias. So I think, I think the move we're seeing today is a move that I think we're going to slowly head in the same direction throughout the course of the week. As long as there's no bad news, and I don't foresee, at least data, some of the headlines really causing that bad news.
Yeah. Interesting. So that's
Kathy, do you want to pull up any of your charts and kind of share what you're looking at?
I mean, everything is just in consolidation mode, and it's really not that interesting.
Not that exciting.
Yeah, and we're just waiting for direction. And there's no specific currency setup that I'm very excited about. Maybe dollar CAD, which I'll show you. Hold on a second. Let me pull up my dollar CAD chart. Okay, so maybe dollar CAD, because we've had this reversal pattern on Friday with a huge wick closing, below the midpoint. Today, we've dropped below the 20 SMA. If we close underneath 137, I think there's a good chance we could slide into this zone here around 135.75, 136. And that would be consistent with my view that oil prices are recovering. And we had, strong Canadian retail sales numbers on Friday. So, I think this is something that I'm watching pretty closely.
Yeah, Kathy was long CAD on the crosses all morning long today. So that's interesting.
Yeah, it was short dollar CAD, straight out as well. Yeah. And that was the smoothest trade in an otherwise choppy day.
Okay, sounds good. Okay.
Well, guys, thank you so much, as usual, coming in and obviously sharing your knowledge. Again, not a whole lot of news, but obviously we've got, Governor Barr. He's testifying with to the Senate, to the House. That should. How do we think that's not a Jerome Powell volatility, is it, or what do we think is going to happen with that?
No, I don't think so.
It doesn't move like that.
I don't think it's going to move the needle much. Exactly. I think like Kay said, the big story will be in May. Until then, we're just twiddling our thumbs and hoping that there's no more panic. I really don't want to see any more panic.
Gotcha.
All right.
Well, guys, thank you so much again for joining us. Obviously, Monday, as you know, we just kind of assess the market, see what's going to happen. I think our slogan, assess, don't guess. It is chopping around a lot. For the traders out there who are viewing us right now, stop loss is tight, right? Make sure your risk rewards are healthy. Take your profits off the table, like you guys always say. Thank you so much for coming and sharing your knowledge today. We will see you guys back Friday and really talk about what actually happens, right, on Traders Therapy.
Yep. Sounds great. Sounds great.
All
right, guys. Thank you so much.